In a stunning action aimed to contain the banking crisis that has recently infected the U.S. financial system, regulators took control of First Republic Bank and sold it to JPMorgan Chase on Monday. In terms of assets, First Republic is the second largest U.S. bank to fail after Washington Mutual, which went under during the 2008 financial crisis and was also bought by JPMorgan. The assets of First Republic, which was established in 1985 and was the 14th largest U.S. bank as of earlier this year, were hit by the increase in interest rates, and the business had fought to survive after SVB and Signature Bank went down in March, frightening investors and depositors. After much frenzied work by authorities over the weekend, the Federal Deposit Insurance Corporation announced its acquisition of First Republic and subsequent sale to JPMorgan just hours before U.S. markets opened. 84 First Republic locations in 8 states reopened as JPMorgan locations on Monday. Investors seem to have approved of JPMorgan's acquisition, causing the bank stock to rise 3.5% on Monday. In this transaction, First Republic stockholders and debt holders will lose everything, as is customary when a bank is placed under government receivership. The First Republic name and logo will gradually disappear, and the bank's branches will change to JPMorgan Chase locations. First Republic collapsed, along with Silicon Valley Bank and Signature Bank, due to loans and investments that lost billions of dollars in value as a result of the Federal Reserve's hasty increase in interest rates to combat inflation. Wealthy customers of First Republic started withholding their money as soon as they could once it became clear that those assets were suddenly worth significantly less, and investors sold its shares. The First Republic and Silicon Valley Bank had committed the ultimate sin by expanding too quickly when interest rates were close to 0%. There were probably other banks too following this practice. However, it is a small group since the vast majority of banks decided against collecting pennies in front of a steamroller. After weeks of trying to either save the bank or find a buyer outside of a government takeover, First Republic finally closed its doors. By last week, it was obvious that there was no other choice besides a government takeover following an unsettling earnings report in which the bank announced that clients had withdrawn more than half of the deposits. Federal regulators have been on the defensive as a result of the banking crisis since it has exposed the flaws that apparently should have been discovered and addressed by the government months ago. The Fed and the FDIC released findings last week in which they criticized their own actions in failing to effectively monitor Silicon Valley Bank and Signature Bank. The reports also charged the banks with ineffective management and excessive risk-taking. Similar to Silicon Valley Bank, First Republic had a sizable clientele in the startup sector as well as in the financial sector, including senior bankers and hedge fund managers. Overall, there are many issues going on with the American financial system. Bank lending has been restricted as a result of previous bank failures and rising interest rates, which makes it more difficult for businesses to grow and for people to purchase houses and vehicles. That is one of the factors contributing to the recent slowdown in the economy. Over 560 banks have collapsed in the United States since 2001. If you're wondering why US banks keep failing, watch next our brief explainer on this subject.